Welcome to the Deep Dive. We're here to cut through the noise, pull out the key insights from, well, a lot of information, and give you a shortcut to being really informed. Today, we're diving deep into the Q2 2025 earnings call from McGrath RentCorp, that's MGRC. They're a big player in modular buildings, portable storage, test equipment rentals.
Yeah.
Kind of behind the scenes in a lot of industries.
Right. Construction, education, tech, they touch quite a bit.
And you've told us you're interested in how companies handle these, genuinely mixed market signals we're seeing.
Yeah.
MGRC's latest results, I think they offer a fantastic look into strategic capital allocation, growth plans.
Yeah.
It's really quite insightful.
It really is. This call offers a fascinating lens into how a diversified rental business can, well, not just get through shifting economic landscapes, but actually adapt strategically, maybe even thrive.
So we're going to peel back the layers today.
Yeah.
Look beyond just the numbers.
Exactly. Understand the operational discipline, the growth levers they're pulling, and, what it all points to for their future.
Okay, let's jump straight into those headline numbers then. Second quarter ended June 30th, 2025. And wow, they didn't just meet expectations.
No, they really outperformed pretty much across the board. The market definitely noticed too.
Big positive reaction, yeah.
Absolutely. And the numbers, they tell a compelling story. So GAAP EPS, earnings per share, came in at $1.46.
Okay.
Now, you compare that to what analysts were expecting. Consensus was, what, $1.22 to $1 to $1.25?
So a comfortable beat there.
A very comfortable beat, shows much stronger profitability than expected. And then on the top line, revenue hit $235.6 million.
Which was also above the consensus, right?
Yeah, consensus was around $220.7 million. So again, a solid beat. And this isn't just a small win, that's an 11% year-over-year increase in revenue.
11%. And the EPS jump was even bigger.
Huge jump. 74% year-over-year increase in EPS.
Wow.
Those aren't just good numbers. They really signal some strong operational leverage kicking in.
And beyond those top-line beats, what about adjusted EBITDA? That's always a key metric.
Right. Earnings before interest, taxes, depreciation, and amortization. It came in strong at $86.5 million.
Okay, how does that compare?
That's a solid 3% increase year over year. And crucially, the margin stayed really healthy, about 36.7%.
Almost 37 cents operating profit for every dollar of revenue, roughly speaking, before financing and non-cash stuff.
Exactly. Very healthy. And income from operations also saw a good bump, up 5% to $57.2 million.
Okay.
And something else notable, especially if you're thinking long term, their commitment to shareholder returns.
Ah, yes, the dividend.
They declared 0.485 cents per share, and this marks their 34th consecutive annual increase.
34 years. That's consistent.
It's more than just a number, right? It's a powerful signal. It tells you management is confident in their financial stability, their cash flow, their future outlook, even with all the economic dynamics out there.
Suggests real operational discipline baked in over years.
Precisely.
All right, fantastic snapshot. So let's unpack this, dig deeper into the segments. What really stood out in Mobile Modular? That's their biggest piece, right?
It is. And Mobile Modular had a really robust quarter, showed resilience, showed targeted growth. Total revenues were up 8% to $156 million.
Okay.
And rental revenues specifically up a solid 5% year over year. And it wasn't just one thing's strength in both commercial and education sectors.
Interesting. Diversified within the segment, too.
Right. And what's really fascinating and kind of points to good execution is how their higher margin service offerings performed.
The add-ons. Mobile Modular Plus.
Exactly. Things like furniture, insurance, tech. Those revenues grew quite a bit, $9.2 million compared to $7.5 million a year ago.
Nice job.
And site-related services to installation, removal up to $6.5 million from $5.8 million. So they're not just renting boxes, they're successfully attaching these extra profitable services.
Makes sense. And what about actual modular sales, like permanent structures?
Also strong, up 13%. They mentioned a new modular sales growth initiative helping there. So seems like they're actively going after bigger, more complex projects now, expanding into higher value stuff.
And Enviroplex, their classroom manufacturing unit within that segment.
Yeah, can't forget them. Had a remarkably strong quarter, operating at high capacity, sales revenue up, margins up, suggests education demand is really humming along.
Okay, so Mobile Modular looks good. But what about the other pieces? Portable storage and TRS-RenTelco, how do they fit in? Same story or different dynamics?
That's crucial because the diversification is really MGRC's strength, I think.
Right.
So portable storage, well, it's still facing a bit of a softer demand environment compared to last year. Rental revenues were down 5% year over year.
Okay, so a bit weaker there.
But, and this is important, it showed a very encouraging sequential improvement. Rental revenues were actually up 5% from Q1 of this year.
Quarter-over-quarter improvement. That is noteworthy.
It really is. Management flagged positive recent shipment trends, more, quote, activity. June apparently saw the most units shipped since way back in January 2024.
So the question is this a turning point for portable storage? A real recovery starting, or just, seasonal noise?
Exactly. It's definitely a glimmer of hope, though. Maybe the worst is behind them in that specific market.
Okay, that sequential uptick is definitely something to watch. And TRS-RenTelco, the test equipment side, that usually holds up well, doesn't it?
It did. Continued its positive momentum, underscores that value of diversification again.
Right.
Rental revenues for TRS grew a healthy 7% year over year. Utilization improved too, both sequentially and year over year, up to a solid 65%.
So strong demand, efficient use of assets there.
Yep. And they mentioned their rental pipeline looks significantly stronger than a year ago. So management seems pretty confident that this rebound is sustainable.
It really shows how having these different pieces helps them manage market swings, right? Weakness in one area gets balanced out.
Absolutely. It acts as a vital buffer.
So moving beyond the segments, it sounds like management's being really deliberate about the overall strategy. What key initiatives did they highlight on the call? What's shaping the future here?
Yeah, this takes us right into their capital allocation and the broader operational strategy. And you see some real discipline here.
Okay.
They've shown, I'd say, remarkable tactical restraint on new equipment spending. CapEx is way down, only $50 million year to date compared to $145 million this time last year.
Big drop. So they're pulling back hard on buying new stuff.
Exactly. But it's not just cutting costs blindly. It reflects a very clear, intentional focus on getting the most out of the existing fleet.
Right. Maximizing utilization.
Rigorously readying and deploying what they already have. This helps preserve margins even with the costs of prepping and moving units, and it signals a cautious but very efficient approach to asset management right now.
Okay, so playing defense on CapEx?
Yeah.
But what about growth? Are they just trimming fat, or are they still planting seeds for the future?
Oh, they're absolutely still positioning for growth, just very targeted. It's not just trimming fat, it's investing strategically.
How so?
Well, even with that lower CapEx on new fleet, they closed 2 tuck-in acquisitions in Q2. Small deals, $22 million combined.
Bolt-ons, basically.
Exactly. Easily integrated. One was a modular company in the Midwest, the other portable storage in the Southeast. Expands their map, leverages their existing services, incremental growth without huge merger risks. And they've also been hiring new sales reps strategically, even ahead of schedule, increasing their sales power, as they put it, especially focused on handling those larger, more complex modular building deals we talked about.
So investing in people, expanding geographic reach, short-term costs for longer-term gains.
That's the bet. SG&A might tick up short-term, but these are deliberate investments expected to pay off down the road as these new resources get up to speed.
And it's not just physical expansion or people, right? They mentioned digital, too, modernizing the business.
Precisely. Investing heavily in IT systems. They know tech edge matters just as much as having the physical fleet.
Like what specifically?
Things like cloud migration, putting in a new CRM system, for better customer relationships and sales tracking, and even exploring AI applications.
AI, interesting.
Yeah. It's all about making sure they're easy to do business with, agile, competitive, enhancing the customer experience, driving internal efficiencies, crucial stuff.
And management used this phrase, cleaner capital allocation canvas. What was the context for that? Sounds quite deliberate.
It is. Very insightful phrase. It refers directly back to when the Will-Scott merger was terminated, late 2024.
Right. That deal fell through.
And MGRC got a hefty $180 million termination fee.
Okay.
So that removed a big cloud of uncertainty deal overhang, as they call it.
Yeah.
But more importantly, it dramatically boosted their financial flexibility.
Gave them cash and a clear path.
Exactly. Now they can lean much harder into organic growth, those service attachments, the strategic tuck-ins. They just have a lot more options for deploying capital now.
Makes sense. And finally, there was something about a tax benefit. Always nice to get a little help from Uncle Sam.
Yes, and potentially a significant one. New federal tax rules on how they depreciate rental equipment.
Okay.
Expected to add about $10 million to $15 million to free cash flow this fiscal year, 2025.
Nice tailwind.
But here's the interesting part. Management explicitly said the benefit is actually less pronounced this year because their CapEx is low. The way the legislation works, the benefit could actually be greater in future years if and when they need to ramp up capital spending again to support growth.
So the benefit scales up exactly when they might need it most, when they start buying more equipment again.
That's the idea, a financial tailwind that potentially grows with investment. Pretty neat.
Okay, so we've got strong Q2 results, this disciplined capital spending, strategic investments, a stronger balance sheet, this tax kicker. What's the overall outlook? What guidance did they give for the rest of the year? Feeling more optimistic?
The sentiment is definitely incrementally more positive. Yes, they actually raised their full year 2025 outlook.
Raised guidance. Okay.
They're now projecting total revenue between $925 million and $960 million. That's up from the previous range.
Good sign. EBITDA too.
Adjusted EBITDA guidance also bumped up, now expected between $347 million and $356 million.
But CapEx guidance stayed the same.
Critically, yes, unchanged at $115 million to $125 million. Reinforces that discipline, optimize the existing fleet first, then maybe buy more later. Very consistent message.
So they're feeling a bit better about the second half, even with all the talk about market uncertainty.
That's the feel. They noted market conditions haven't really gotten worse, and in some spots, they're seeing slight improvements in key indicators.
Like what?
Specifically mentioned the Architecture Billings Index. That's a key leading indicator for non-residential construction, and seeing better construction backlogs too. So while demand is still, mixed in some areas, as they put it, that diversified portfolio really provides resilience. Education, commercial, portable storage, test equipment. A dip in one can be offset by strength elsewhere.
Yeah, the diversification seems key. And we should also touch on the pricing dynamics in modular, right? That gap between old and new rates.
Oh, absolutely. Fascinating point. It's like a built-in tailwind for them. Spot rates for new rentals are pretty stable.
Okay.
But there's still this big gap between the average rate on their existing fleet versus what they get for new units going out.
How big a gap?
The average monthly revenue per unit already on rent was $840, which is good, up 6% year over year. But units shipped out over the last 12 months averaged $11,168 per month.
Wow, that's almost 40% higher on new placements.
Roughly 39% lower on the existing fleet, yeah. And while that gap narrowed slightly from Q1, it's still massive.
So as older, cheaper contracts expire,
and new units go out at these much higher rates, it automatically lifts the overall average revenue per unit. Even if spot rates themselves don't move much, it's like a guaranteed revenue booster built into their existing asset base rolling forward.
significant embedded opportunity there.
Definitely.
Okay, this whole picture, it really suggests a company navigating some choppy waters with real strategic skill, capitalizing on internal strengths, making smart, targeted bets.
Yeah, it's a testament to balancing that present discipline with positioning for future growth, and the market clearly liked what it heard.
Right, now for our favorite part, the This Is Not Financial Advice segment. Time to pitch an outrageous but plausible trade idea based on everything we've just discussed about MGRC.
Okay. Given MGRC's disciplined CapEx, that laser focus on using the fleet they already have, and that interesting tax tailwind, here's a thought. A reinvestment arbitrage trade.
Reinvestment arbitrage, intriguing name. Unpack that for us. What's the inefficiency we're trying to exploit?
Well, the outrageous but plausible angle is that the market might be seriously underestimating MGRC's deferred capital spending power.
Okay. Deferred power.
Yeah, look, they've intentionally pulled back on buying new stuff this year, right? To squeeze more out of existing assets.
Right, we covered that.
But that tax legislation gives them a $10-15 million cash flow bump this year. And management explicitly said the benefit could be greater in future years if CapEx goes up.
So there's this built-in financial incentive for them to eventually spend more.
Yeah.
Optionality.
Precisely. Financially incentivized, delayed capital deployment. It's suppressed now, but for a growth company like this, it feels kind of inevitable, right?
So the trade is betting on them eventually opening the CapEx taps again, but with extra juice.
Exactly. You bet that when MGRC does decide to ramp up new fleet investment, maybe, say, 18-24 months out when the market looks clearer, those investments get supercharged by that tax incentive.
Okay, so how do you structure the trade? Long MGRC.
That's part one. Go long MGRC, medium-term horizon, expecting the market to eventually recognize and re-rate this stored potential when it gets unlocked. But To add the outrageous layer,
Uh-huh.
you simultaneously go long on a basket of their key equipment suppliers. Or maybe even pick a specific niche supplier of, say, modular components, and you do that part with long-dated call options.
Ah, options for leverage on the supplier side. So you're betting that when MGRC finally hits go on big fleet investments.
Their suppliers will see a disproportionate benefit, orders ramp up, and maybe that's magnified because MGRC itself is getting better tax treatment on that spending, creating this sort of positive feedback loop.
A virtuous cycle almost,
Yeah.
arbitraging the timing of MGRC's stored CapEx potential.
Exactly. You're playing the delay. Betting on the inevitable fleet refresh, supercharged by that underappreciated tax kicker and the ripple effects down the supply chain. It's a bet on the cascade.
Nicely put. And of course.
This is not financial advice, just an idea to chew on.
What a fascinating deep dive into McGrath RentCorp's Q2. We've really seen how solid results, that tactical capital management and smart growth moves are positioning them, even in a tricky market.
Yeah, from the resilience across their different businesses to the investments in tech and those bolt-on acquisitions, they're showing how to adapt and, well, thrive. That raised outlook, the cautious optimism. It paints an encouraging picture.
Definitely a case study in managing through uncertainty, using discipline today to build for tomorrow.
Absolutely. Shows that even in industries that might seem traditional, there's plenty of room for innovation and smart strategy to create value.
Well, thank you for joining us for this insightful summary. We hope this deep dive gave you a much clearer picture of MGRC's latest moves and what it might signal for the broader market. Maybe gets you thinking about how other companies are balancing things right now.
Hope so.
Until next time, keep those tickers talking.